Jason?
I am now.
Awesome.
I'll repeat what I said. So $4,000 is the taxable amount for AMT purposes, not the grossed up amount of $5,520. We get to claim the capital gain deduction. Need you to know that one. And most of all, most importantly, we get just a blanket deduction of $40,000 against AMT. I have no idea how they got that number, but I'm happy to claim it on my own tax return. So that's how we get down to AMT taxable income. Now, just for the benefit of students who are joining this telecast now, I'm just explaining, because I didn't turn on the cameras I should have, I'm just explaining what AMT is briefly. As time went on, there are a whole bunch of deductions, and the government at one point said, rich people are getting away without paying tax. Let's create a second parallel universe tax deduction for them to do, tax calculation. In most cases, the AMT taxable income is higher than regular taxable income. The good news is that the rate for AMT, alternative minimum tax, is only 15%, which is the same rate as the lowest tax bracket for federal purposes. So although our taxable income is higher, our tax rate is lower. The deal is that if your alternative minimum tax is higher than your regular tax, you have to pay the higher of the two. It's possible to recover the higher of the two over the next 7 years. You do both the regular calculation and the AMT calculation. And if regular tax is higher than AMT anytime in the next 7 years, you can get back the over tax that you paid in the first year. And we've just gone through the calculation on page 393 example. And the only adjustments I need you to know for AMT purposes are the fact that we pick up the actual amount of dividends for AMT, not the grossed up amount. And we are allowed the capital gain exemption. And we pick up 80% of capital gains, not 50% for AMT purposes. And there's a $40,000 exemption that everybody is allowed to claim. That's $40,000 per year for AMT purposes. And then we get down to AMT taxable income. Now you see $349,000 on the bottom of page 393. And 349 times 15% is $52,350. So again, it's 349. So we're going to run two separate calculations here. One is AMT and one is regular tax. And the point of this exercise is to make sure that we're comparing the right thing to the right thing to determine which one we pay the greater of. So in regular tax, what we've got is $270,000. $275,20 is taxable income. Regular tax thereon, turn the page, is $65,622. Now you notice that in this particular case, that's net of two credits. The personal credit, how much is the personal credit base?
10,822.
10,822 times 15% is 1,623. And the dividend tax credit. Those are exactly the same credits that I want you to do here. So I want you to take 1,623 off this. But I don't want you to claim the dividend tax credit for AMT. And the reason for that is we already have avoided the gross up for AMT because, as I mentioned, we report only the actual amount, not the grossed up amount. So dividend tax credit here, DTC Yes. DTC here? No. I get this math as being 50,727. So AMT taxable income times 15% minus basic credit is 50,727. You okay with that? Versus federal tax, and this is only federal tax we're speaking of here, not provincial, just federal, of 65,622. We pay the higher of the two, we pay regular tax. So in this case, AMT, it's good that we did the calculation, but it didn't either help us or hurt us. So to review, regular tax, just calculate like regular tax down to the bottom of net federal taxes after credit, etc. AMT, please only use the basic credit and don't calculate the dividend tax credit. Yes?
I just have a question about the $40,000 exemption. So one of the tax preferences under the tax preferences, it says a basic exemption of $40,000 on 393. But then on 392, if you look at the second paragraph or that middle paragraph in the bottom area, it says when the AMT is calculated, taxable income is revised to exclude certain tax preference items to the extent that they exceed a base amount of $40,000.
That confuses me.
Yeah, is it all? What I'm trying to ask is, are you always deducting $40,000, or can it ever be a different number?
No, the deduction is always 40,000.
Okay.
And that's regardless of what tax preference items you have or anything. It's always just a standard $40,000. And it's been 40,000 forever, ever since this rule came in, which was 20 years ago. They haven't changed it for inflation, unfortunately. Any other questions on AMT? Page 394, the special tax and old age security benefits. This is referred to as the clawback. Has anybody heard that expression? Clawback? What do you understand that it means?
It was a while ago I heard it, but it's something to do with, you get a certain, I can't remember exactly, but.
You get something and somebody takes it away.
Yeah.
Yes?
It's so that people who make too much money don't get money from the government, which is what the old age security benefit is.
Yeah, essentially, one used to get old age security regardless of your income. And then someone said, well, let's put an income test on it. And then somebody else said, well, let's mess up the income tax system some more and we'll run that income test through the income tax system and add 2 or 3 more pages to the Income Tax Act. So that's essentially what it is. It's actually a pretty simple calculation, and running it through your tax return is actually a fairly elegant thing to do. My problem with it is that I get into trouble every year because my mother gets old age security and she gets so much money, and then at the end of the year she has to give some back. And I usually get a phone call about why that is and so on. But the tax return software does it. It's for people who are 65 years old and older. And essentially it is, just as here, the special tax is 15% of net income in excess of 69,562. Where might we find that in the tables?
Oh, it's under the tax credits again, isn't it? Or is that a different one? Oh, no, that's a different one. Well, is that the same, that's a different thing than the age 65 and over, right?
This is different from the age 65 thing and over. That's an age credit. This is a clawback, which is different. The only place I've been able to find it, except looking inside the Act, which table is easier, is on page 39, which is XXXIX. Under the notes, item A, second paragraph. You can run your highlighter over that, and I like how they explained it. If an individual's net income, not taxable income, but net income, is higher than 69,562 actually, but I don't care if you use 69,560. 15% of the excess must be repaid.
So you're saying that the textbook's right, but the notes in the back section are?
Correct.
Oh.
The reason is that this is an inflation calculation. I'm guessing that the inflation calculation was finalized before the Tax Act, or the tax textbook was prepared, but not before the Act was prepared. So there's a $2 difference, which let's agree is immaterial.
So it's like a negative credit.
It's like a negative credit. And clawback is actually a pretty good word for it. I just have one thing to say about final returns of deceased taxpayers. There's really nothing in this part 7, that I need you to know. You might, for your interest, like to read it. It's possible that if a person has losses, capital losses particularly, that would otherwise expire because of death, we actually get to use those in the last taxation year. The thing that I most want you to know is that when you die, and this is from a previous chapter, you're deemed to dispose of everything, except that what you leave to your spouse you get a rollover for. That is, you have no deemed capital gain, and your spouse picks everything up at your cost base. Yes?
So if somebody passes away in Canada, but they never worked, like an older person passes away, but they never worked in the country, they wouldn't get any, like when somebody goes to file their trust or whatnot, they would not get any credits or anything back, right?
Well, do they have assets?
No?
Then you're right, they're probably kind of invisible as far as Canadian taxation is concerned. But if they have assets, they have to
Yeah.
report their assets, the sale of their assets.
Okay.
Do they have a social insurance number?
Yeah?
They should file a tax return.
What if they weren't born here?
Doesn't matter.
Okay.
If they're a Canadian resident, not even a Canadian citizen, but just a Canadian resident, they have to file it. And when is that return due?
6 months after the end of the year or
Or
their
their
death,
passing?
whichever is later.
Tax return is due the later of April 30th next year or 6 months after death. Oh, and today's March 12th. What's important for me on March 15th?
Pay installment.
I have to pay my first quarterly installment for 2013 on Friday. Hooray, yeah.
We'll think about it.
I paid it already. It wasn't a big deal. Fewer tears than in prior years. Anything else before we turn the page and go to corporations? Yes?
Do we have to know about supplement for the OAS supplements? Do we have to know much about that, or?
Just that formula, 15% of the excess over that amount. That's it. Now you're probably thinking corporations. I mean, if individuals is this complicated, corporations must be like this. Not necessarily, actually. And in fact, the calculation of net income is really the same. Not only that, corporations don't have like employment income and stuff like that. Really all they've got is income from property and income from business. So in most cases, the calculation of net income, taxable income of a corporation is actually pretty straightforward. Often more straightforward than, for example, a salesperson. Please turn to page 421 and also page 40. So 421 and 40. I just want to show you that these are the same. So on page 40 it says that the net income for tax purposes for corporations is reduced by certain things to arrive at taxable income. And page 421 is just sort of a graphical portrayal of the same thing, written as a formula. First thing you notice right off the hop is that donations are a deduction rather than a credit like they are for individuals. Not much else to say about that. Please go to page 422. So one of the items between net income and taxable income, one of the deductions allowed is with respect to losses carried forward from prior years or carried back from future years. Same as individuals. Except for corporations, there's something interesting, which is that generations ago, people would buy a corporation sometimes just because it had losses. This is called loss trading. And if I had started a business and lost $10 million, and somebody bought my business, maybe they didn't even care about my business, but they might have given me money for my shares, which otherwise were useless, just because I had $10 million worth of losses. And if, say, the corporate tax rate was 30%, those losses could be worth the present value of $3 million, depending on how long it took me to claim the losses. So the government said, no, we got to rein that in. So they came up with some rules with respect to losses. When I acquire control of a corporation, these rules apply. And it's when I acquire control of a corporation from an arm's length party. So if I buy your company, these rules apply. They do not apply if I buy my brother's company. Please turn to 249 bracket 4. .249 bracket 4. First thing is, on the day that I acquire the company, a deemed year end happens. So today's March 12th, I might have bought your company today, and maybe your company's next year end was going to be on December 31st, 2013. But boom, on March 12th, 2013, there's a deemed year end, and we are required to file a tax return for the taxation year that started January 1st, 2013 to March 12th, 2013. We call that a stub period tax return. We have to file a stub period tax return.
Excuse me, if the regular year end is not December 31st, would it start from January 1st? Is it from the first of the regular fiscal year?
It's from the first day of the regular fiscal year. So in my example, that was January 1st. It could also be October 1st, It could also have been March 1st if we had a February 28th year end. We're not even finished closing the books, but the company was acquired today. We would have a stub period of 12 days.
Thank you.
So it's from the first day of the fiscal year in which the acquisition of control happened. And again, everything I'm talking about right now is only if we acquire control of a company at arm's length. Please go to page 422 and 111.5a.
I have a question. Does that make the fiscal year for the new owners, does it start on the date of acquisition then, going forward?
Yes, the fiscal year of the new owners starts on March 13th. The good news is they can pick whatever next year end whenever they want. So in my example, we had a December 31st year end, and then I bought the company on March 12th. My first, or the company's first taxation year under my ownership starts March 13th. And let's say I pick September 30th as a year end, because that's the year end of all my other companies, and the accounting would be easier if I could account for all my other companies, all my companies' tax returns, fiscal, financial statements, based on the same year end. I can pick whatever year end I want going forward.
And then you'd have to do another stub tax return?
Then I'd have to do another stub period tax return from March 13th to September 30th in this example. Yeah, all these tax returns are getting a little bit much, but that's how it is.
And you said it's called a stub year tax return?
Stub period.
Well, stub period.
Yep. And we usually put a hyphen in there. So the first thing that happens on an acquisition of control, and remember this is arm's length, deemed year end, by the way, if I say change of control, I mean the same thing. The Income Tax Act actually refers to it as an acquisition of control, but the textbook and people on the street also call it a change of control. So acquisition of control, change of control, same thing. The next thing is I look at the loss position. Remember what I said, that the government is really sensitive about people buying companies and using their losses? So if you look at 111.5, (111.5a). Where at any time control of a corporation has been acquired, et cetera, et cetera, et cetera. No amount in respect of its non-capital loss. I don't want to talk about farm losses today. I want you to know about non-capital losses and net capital losses.
Are you actually reading from there?
Yep, 111.5, the preamble.
Oh, in the preamble, oh, okay.
Where at any time control of a corporation has been acquired,
Okay.
and I'll skip some words. No amount in respect of its non-capital loss is deductible for a taxation year ending after that time, except that. So it starts out by saying your non-capital losses are toast, except such portion of the loss 1, only if the business was carried on by the corporation for profit or with a reasonable expectation of profit throughout the year. So right off the bat, I have to continue to carry on the business that gave rise to the losses. We call that the lost business.
So can you repeat that? I heard the carry loss business, but the one sentence before that.
I have to carry on the business that gave rise to the losses. If I think I'm going to buy the company and shut down the lost business tomorrow, I can't use any of the losses. I can't use any of the non-capital losses that occurred from the business that I'm shutting down. So, first takeaway is this is only for turnaround situations. I only get to claim the loss if I continue to operate the business and with a reasonable expectation of profit. That's a very tall order.
What do they mean by with a reasonable expectation of profit?
I need to have a business plan that shows that we're going to turn this thing around. Either by sort of integrating it with our existing business, which might be helpful, or we hired new management, or we refinanced it, or something like that. So in a real business sense, we have to demonstrate that we actually have a plan to turn this thing around, and we actually expect that we're going to be profitable. Again, a very tall order. That's just the first test. And we get to claim those losses, this is item little 2 now, only to the extent of the corporation's income from that business. Again, a very harsh test in order to use these losses. Now it gets a little better. And, I'm going to skip some words here. From any other business, substantially all of the income of which was derived from the sale, leasing, rental, development, as the case may be, of similar properties or the rendering of similar services. So although we need to carry on the lost business with a reasonable expectation of profit, if we also carry on another business that is similar, we get to use the losses against that business's income. Even if the lost business, which we're still carrying on, continues to lose money despite our best efforts, we at least get to claim the losses against our similar business that we might have always had. The picture just got a little bit better. Question is, what's a similar business? Court cases are fought on this. There's no definition in the Income Tax Act. But generally speaking, if I say I'm in the retail business and I bought a company that also carries on a retail business and it lost money, and maybe they were retailing shoes, but I'm retailing shirts, I'm probably okay. As long as I have a reasonable expectation of profit from the shoe selling business, which I still continue, I can likely use those losses against my profits from my shirt business.
But if you bought a company that was having trouble selling shirts and you sold shirts, you could immediately claim those losses against yours because it's already similar?
As long as it's similar, it's similar. So if they sold shirts and I sell shirts, it's maybe more similar, but I don't get to claim the losses any faster. It might just be easier for me if CRA says, what now? They sold something, you sold something else, that's similar? Obviously I would have an easier time if we both sold the same commodity, but it's not strictly speaking completely necessary. And I won't try to trick you by saying, Joe bought a company, it sold this, our existing company sold this, are they similar? I don't need you to worry about that. I will give you facts that say, this company sold something similar to what we're selling. Yes?
If you're in a situation where you bought the retail store with the shoes and there's losses that can be claimed, that doesn't mean at that point in time when you claim those losses against the shirts retailer, could it mean that the shoes store is continuously making losses? Because wouldn't that be a scary situation, even though you were planning to turn shoes around, that now your shirts is also going down? Like, is that a possibility, or?
Yep, question is, what if the lost business continues to lose money, which is scary on its own? What's the tax treatment? This is only about the losses that happened before we bought the company.
Okay.
If the lost business continues to lose money, that just gets added to our non-capital losses every year. Or if our other businesses are profitable, we just simply claim those losses against the income of our other business.
Okay, so once, just moving forward, those losses can be claimed against the entire business or anything?
Yes, the losses that we acquired can be used against the entire business, but only a subset thereof. And the subset is the same or similar business. So if in our example, we bought a shoe store that was losing money, and we sell shirts, let's say we also have a hotel. This is all in the same company. And if the shirts selling business is similar to the shoe selling business, we can deduct the shoe losses which occurred before the date of purchase against our future shirt profits, but not against our hotel profits.
Okay, but in the future, can the shoe losses be claimed against the hotel?
The shoe losses that occur after we bought the company can be used against hotel profits. Those aren't restricted in any way. This restriction is only about the losses that we bought. Yep, the previous losses that the previous owner had incurred.
And you said there are non-capital losses going forward after the purchase date, right?
Yes, this foregoing discussion is only about non-capital losses. And the reason for that is that the net capital losses carried forward just disappear. You cannot claim them after the acquisition of control. They just go up in smoke. I never really understood the reason for that, but that's just how it is. It's very simple. It's easier for you to learn actually than the non-capital loss situation. Net capital losses just disappear on an acquisition of control at arm's length.
Should I ask one more question?
In a second.
Okay.
Just before I address that question, please turn to 111.4. 111.4, notwithstanding subsection 1, that means setting aside subsection 1, which, by the way, is a section that normally says that we can carry forward losses and carry back losses. Notwithstanding that, where at any time control of a corporation has been acquired by a person, no amount in respect of a net capital loss for a taxation year ending before that time is deductible in computing the corporation's taxable income afterward. So that's the reason, the statutory reason why net capital losses disappear. Marlo.
I know, that's okay, I'm gonna listen to the recording.
So then people said, okay, if our losses are either restricted, non-capital losses, or net capital losses disappear, maybe we'll do some stuff like not claim all of the capital gain, capital cost allowance like depreciation. Because why run up our losses? If we run up our losses and they are restricted. If a person who buys us, if it's harder for them to claim the losses, let's keep our losses really low, but let's keep our UCC really high. So that when somebody buys us, they'll claim big capital cost allowance, and that's just as good as claiming losses. And the capital cost allowance doesn't have restrictions like Section 111 says. Capital cost allowance, you don't have to, reasonable expectation of profit, et cetera, et cetera. So the government said, okay, when you have this deemed year end that happens as a result of 249.4, we're also going to mark to market your depreciable property. What that means is, let's say my UCC is $6 million. And I haven't been claiming capital cost allowance because I was losing money anyway. But if the fair market value of my depreciable property is only $1 million, my UCC gets ground down from 6 million to 1 million. That gives me a $5 million deduction that I deduct on my stub period tax return, and therefore increases my non-capital losses. Now my non-capital losses are subject to all these tests. Oh, reasonable expectation of profit, got to continue the lost business, same and similar business. I have just, or the government has made me, convert my giant UCC into losses that are now subject to tests before the acquirer can deduct them. I call that mark to market. Has anybody heard that term before? I think it's a term also used in accounting theory, where you take whatever the number is and you restate it based on what the fair market value is. Mark to market. So that applies in depreciable properties, and it converts UCC into non-capital losses. For capital properties, it's even more draconian. Let's say I've got a piece of land, its adjusted cost base is $3 million, but today for some reason it's worth less, it's only worth $1 million. I have to mark that to market. I have to take my $3 million and turn it into $1 million. That means I have a capital loss of $2 million and a net capital loss of $1 million, and on the acquisition of control, it disappears. Terrible result. Unfortunately very true and happens often. And there's also similar adjustment for eligible capital property. Please turn to 111.4C.
There's a similar adjustment for eligible. How are they going to determine what the fair market value of the eligible property is? They'll just do a goodwill calculation, or?
How do you determine the fair market value of anything? You hire a valuator or whatever it is, or an appraiser for real estate, et cetera, et cetera.
What if there's a capital gain when they mark it to market?
If there's a capital gain when it's marked to market, nothing happens. We are not required to report a capital gain.
What's the adjusted cost base going forward? Is it the higher?
The lower.
The lower, even if there's a gain?
No. If the mark to market results in a decrease, that's what the the adjusted cost base is going forward. The lower ACB and the lower UCC in the previous example.
But if there was a gain and they mark to market, then they can, I mean, with
This
that.
this mark to market only applies if there's a loss.
Oh. And same thing with the eligible capital property?
Correct.
Thank you.
If you look at page 423, I spoke of depreciable property, which is the second last bullet point, and non-depreciable capital property, which is the first bullet point on page 424. The only other one I need you to know about is inventory. So we mark to market inventory, depreciable property, cumulative eligible property as well. So that's inventory, depreciable property, CEC, and non-depreciable capital property. Any questions on that before we move on? If none, you can cross everything out starting after the example on page 425. So cross out loss utilization in corporate groups. And the top of page 426, and we resume on the bottom of page 426, dividends from other Canadian corporations.
Excuse me, is the example on the bottom of page 424 and 425, in your opinion, decent? You recommend that?
Yeah, it's pretty good. It's got a few things in there that I don't need you to know about, like accounts receivable.
Okay,
But if you go through the rest of it,
thank you.
you will get value from it.
Thank you.
And again, that was the example on page 424 and 425. Dividends from other corporations, please turn first to page 421. So among the list of deductions to arrive at taxable income for a corporation are dividends from taxable Canadian corporations and dividends from foreign affiliates. Taxable Canadian corporations, that's like every corporation except a charity or a nonprofit. So every corporation that you're aware of or that might come up in this course is a taxable Canadian corporation. A foreign affiliate is obviously a foreign corporation in which the Canadian corporation owns at least 10% of the equity. So dividends received from a taxable Canadian corporation get included in income, so they're included in net income, income from property actually, but then we get to deduct them.
It's a 1-for-1?
It's a 1-for-1.
Okay.
They're included in income from property just under general principles. It's just income, which means you need a special deduction to make them deductible from taxable income. That arises in 113 bracket 1. Please turn there briefly. So 113 bracket 1 gives us a deduction for dividends received from a foreign affiliate. And 112 bracket 1 gives us a deduction for dividends received from a Canadian corporation. So again, in both cases, the dividends are firstly included in net income, and then either 112.1 or 113.1 allows us a deduction to arrive at taxable income. Any questions there? Yes?
So, yeah, foreign affiliates, they must own 10%, so they have less than the deduction.
Correct. If the Canadian corporation owns less than 10% of the foreign affiliate corporation, there is no deduction allowed. You might ask, why all this, deduction, including deduction? The government quite correctly says, if we tax dividends inside companies, we're going to have like double or triple taxation. And that makes no sense. The integration principle already has two levels of taxation, right? We've got the corporation and the individual. So an individual owns a company, which owns a company, which owns a company. These dividends are tax-free. This dividend is taxable, and that's as it should be. And the integration principle makes us whole for double taxation. Brings us back more or less to single taxation by way of the gross up in the dividend tax credit and all that kind of stuff. But if this were taxable and this were taxable, it would be a real mess. We'd have like triple or quadruple taxation. So we only charge tax in the Canadian tax system when a corporation pays a dividend to an individual. All this stuff is just noise, it's just an in and an out.
Why the 10% rule on all dividends for affiliates?
Why the 10% rule? I think the government just wanted there to be enough of a ownership presence in the foreign company that it's more than just sort of a portfolio dividend. So for example, if my holding company owns shares of IBM, which would be a lot less than 10%, they're saying, you know what, there isn't really a connection there. My Canadian company is probably not involved in the management of IBM or anything like that. We're just going to call that regular income and not allow a deduction for it. Now I'd like you to skip forward to page 433. This is how we calculate the tax of a corporation. For the time being, I'd like you to draw a line through the investment income column on page 433.
Are we gonna need it later?
You're going to need it later, but I would still use a pen. It doesn't matter. We'll have a whole chapter on it later.
Oh, okay, then I feel less.
So a public company, if you go down to the bottom first, 25%. That's the assumed tax rate that we've been using so far for public companies when we talk about integration. And it's calculated just like you see there. We start at 38%. We get what's called a federal abatement, which is a freebie. And I don't know why it's actually not just 28%, but to make life harder for students and accountants, it's 38% minus 10. Then we get something called the general tax reduction. And you'll notice that that only applies to income of public companies, or, he said, moving 2 columns to the right, business income earned by Canadian-controlled private corporations higher than $500,000. So if I'm a public corporation, it's 38 minus 10 minus 13. If I'm a CCPC, the first 500 is in that middle column, 38 minus 10 minus the small business deduction, which I'll talk about in a second. But if my income is $600,000, and here I'm speaking about business income, not investment income, on the $100,000 excess, I pay federal tax of 15%, calculated identically to how it's calculated for a public corporation, 38 minus 10 minus 13. Man, it'd be great if there were a table for this, right?
Yeah. Do we need to know the provincial tax part of this table?
I'm not there yet. Please turn to page 44, which is XLIV. this so-called general corporation, it says at the caption at the top of the page. So that's a public corporation or business income of a CCPC higher than 500,000. So this is the same table as on page 433. The public corporation column and the CCPC other business income column are the same as this, and they add up to 15%. You okay so far? General M&P income, please draw a line through that. And this time I really mean it, because on the final exam when you're looking at this table, that column general M&P income will confuse you.
Which one do you see table from you look at?
This is C1.
So did you say that the general active business income is for the one, what's making more than $500,000?
That's correct. So that's for a CCPC excess over 500,000, and you might like to write that in there. Or also a public corporation, same thing. M&P income, you see it's the same thing. They used to have what was called the manufacturing and processing credit, and they had that for a number of years before the 13% general rate reduction. Used to have something called the M&P credit. And then they brought in the general rate reduction, which is the same reduction as the M&P credit. Therefore, the M&P credit is redundant. Therefore, I don't even want you to learn about the M&P income, and hence why I skipped about 4 pages in the textbook. So general active business income is how a public company gets taxed, whether or not they're a manufacturer, and it's the business income of a CCPC higher than $500,000. Investment income, you can also draw a line through that. Provincial taxes, you can draw the same lines through M&P income and investment income. And all you need to worry about is the provincial column under general active business income.
That's C2, right?
That is table C2.
So what's the difference between C2 and the bottom part of C1? It's-
They're combined, that's the only difference.
Oh, so this is that squished together.
Yeah, in fact, to be honest with you, C2 is actually not that important. What's important is C1 because it shows the separate federal and provincial rates.
Because we'd be calculating it separately, wouldn't we?
Yep. I'm going to keep moving if you don't mind.
Please.
If you're interested, if you look at Saskatchewan and Ontario, they are 2 provinces where manufacturing is actually subject to a lower tax. So in the column you just crossed out, Saskatchewan's manufacturing tax rate is 10. The general rate in Saskatchewan is 12. And in Ontario, it's 10 versus 11 or 11 and a half.
Where are you reading that from?
On table C1. I just mentioned that for your interest's sake. There are a couple of provinces where manufacturing gets a lower tax rate.
They're crossed out column. Right?
Please look at page 433, the column that says first $500,000 of business income. So as I mentioned before, we start at 38. We get the federal abatement that everybody gets. We do not get the general tax reduction, but we get something better, which is called the small business deduction. And again, this applies in the first $500,000 per year of active business income. Table C5. Don't cross anything out in this table. And I'm only showing it to you now to show you that when we get to about chapter 13, this table will be critical to you. I'm just showing you where it is and show you that it doesn't in fact tie into page 433, that column, first $500,000 of business income. Provincial taxes simply get added onto this. So the federal is something minus something minus something. Provincial is just either one rate or another rate. The first $500,000 of small business income is a low rate, and then there's a high rate in provinces for the general corporation, so public and also active business income higher than 500. I'll just direct you to one other thing, which is on page 432. Does anybody notice anything interesting in the second column, which is provincial tax on income eligible for the $500,000 small business deduction? Anything interesting there?
Manitoba zero.
Manitoba is zero. Manitoba is the only province in the country that charges no tax on small business income. It's actually on the first $400,000, but don't worry about that. I just wanted you to see that 0% rate. If my company does business in more than one province, how do I figure out how much tax I pay? One would think, well, you throw it to the accountants and let them figure out what the profit is in each province. Actually, there's a simpler way, and it's on top of page 433. We take our sales and our wages by province, and then just do the simple average, one plus the other divided by the number of provinces. In this case, there are only 2 provinces. Please take a moment to go through that example, and it's dead simple. It's deceptively simple, and it is. I promise you, there's nothing complicated hiding behind it. Please look at page 434. Now, in previous charts showing integration, it always comes down to 45%, but actually the reality is different. For public corporations, the way it actually works out with public company rates and dividend tax credits and such, we normally end up paying about 1% more tax than if we were somehow able to earn that income personally and pay tax personally at the highest rate. We call that under-integration. In other words, integration didn't work out quite as well as we thought it would. On the next page is over-integration. It actually works out better than we thought. If we run our business through a corporation, small business corporation, and earn $500,000 or less, we actually end up paying less tax, combined tax paid by the company and by me on the dividend, than if I had operated that business through a sole proprietorship. I pay only 43% versus 45% if I had operated it by myself, not through a corporation. I don't care if you remember over-integration and under-integration. What I do need you to know is that for public company or for an active business, a CCPC earning active business income higher than 500, we're 1 percentage point worse off. And for a CCPC earning less than 500, we are 2 percentage points better off. Here's what that makes people do who own CCPCs. If my profit for the year is $1.2 million, I am paying myself a bonus of $700,000 to bring my income down to $500,000 so that I avoid my company paying tax at the high rate, because when I take those retained earnings out later, I will have paid combined taxes on that $700 more than if I had taken it as a salary and paid 45% tax on it. So it's very common for people we call it bonus down to $500,000. And that's even if they start at $6 million or $10 million worth of corporate profits. They're paying themselves a giant bonus to bring themselves down to 500 to avoid this situation on page 434.
So if they do take themselves that huge bonus of $700,000, obviously they need money to operate that company. So do they take the bonus and then immediately reinvest it, or like let's say a large portion of that back into the company like 2 days later, or?
That's exactly what they do. They take the money out and often put it back in. And now instead of retained earnings, the company shows a shareholder's loan payable. And that's just fine. Thanks for listening. See you on Thursday.